equity in that house, though, is not going to be $1 million. You just made your very first mortgage payment. Maybe your equity is $10,000. Okay. Similar to your house, both the total value of the policy, that $1 million death benefit, and your equity in the policy, your cash value, go up over time. As you make premium payments into it, those payments get more efficient over time, similar to your mortgage payment. It gets more efficient over time. So your equity in the policy and the total value of the policy are going up, and you collect rental income. Like if you're a real estate investor, that's the dividend. Okay. In the dividend, we reinvest, quote unquote, into the policy based on the way we design it. So we get this nice compounding growth inside the policy. It's all tax-free, no market risk. Like the real estate investor, when the real estate investor's built up a bunch of equity in one of his properties and he wants to use the equity, it'd be dumb. Then he would lose all that future rental income. He'd lose all that future capital appreciation, and he might have a taxable gain. So instead, he's just going to borrow against his property. Now he can use the equity in that property. Meanwhile, he keeps collecting the rental income. The same thing here, except instead of using real estate, we're using a whole life insurance policy where that death benefit is the asset. And when we borrow against our policy, there are no repayment terms whatsoever. We're not taking on any debt because the collateral we're borrowing against is guaranteed. It's mathematically impossible to default on that loan. Right? Wow. Another rabbit hole, but I think that analogy, helps people. I think that analogy helps people because I've kind of moved, as my business has evolved, I started by talking about banking, and that is what we're doing. But you have to meet people where they are, right? Yeah. And it's too abstract, right? And it doesn't jibe with their experience because people don't understand how banking works. And I don't blame them. Nobody teaches us this. They don't teach you about banking in public schools. I mean, come on. But most people have had the experience of owning a home, the benefits of home ownership, and how a mortgage works. So when you use that analogy, then it starts to make sense to them. Because to your point, cash value and death benefit are not two different things, believe it or not.